When Besant made that statement today, I mean, what did that admit? Panic. That's what it admitted. And therefore, gold and silver said, oh, yeah, we knew that anyway. Now look what the miners did today. Gold's up like 3%, and the miners up 9%. Okay. We'll get on to that in a minute because that's a very important issue. But that's where we are. I think we have a crisis like we've never had that drives the gold move in an ongoing way, because this process, like you said, has been going on for decades, printing money. But now you have the bigger crisis that will cause them to print even more, to do things that we never thought of. Why? To keep the house from burning down.
Global financial markets face unprecedented instability as mounting sovereign debt pressures force central banks into aggressive balance sheet expansion. Systemic currency debasement continues to erode purchasing power worldwide while driving institutional capital toward physical safe haven assets. Michaeloliver, founder of Momentum Structural Analysis, points out that precious metals have officially resolved their intermediate corrective cycle and resumed their primary secular bull trend. Technical momentum oscillators confirm that gold and silver have cleared long-standing overhead structural resistance levels. Based on these structural breakouts, Oliver predicts that accelerating central bank liquidity will drive gold, silver, and mining equities to explosive new highs. Furthermore, ongoing monetary expansion is projected to trigger prolonged dollar weakness as bond market volatility forces emergency interventions. While late market participants suffered during brief pullbacks, the macro-technical alignment confirms that tangible monetary assets are entering their next major impulse phase. The foundational bull trend remains exceptionally strong against fiat debasement. Now, we present the clips from Michaeloliver's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
You see the high back there just short of 5,600, and a very brief spike high, by the way. These are daily bars. So you spent like a couple days up there before you collapsed, okay? But that collapse was literally 2 trading days, really a day and a half of trading. The last day of January, first trading day of February, and you collapsed from just below 5,600 down to 4,400 and something, okay? Wow. Okay, if you look at that low there in February on the left side of that chart, just above 4,400, and drew a line across, you'd see we've done nothing but we've above and below it since then. Right now, this chart is, by the way, a couple weeks old. Gold is now up toward 45.50. Okay. But you'll see there's 3 waves of price selling there. There's the first hit, then you rallied nicely to 5,400. Then there's the second hit, took you to 4,100 area. Then you had another rally up to 48 plus. Then you came down and nipped under 4,000. And now you're 10, 12% above there. Okay. 3 waves of price selling. Now look at the bottom chart. What that does, it simply measures each daily bar, price bar. Where is it in relationship to the 50-day moving average, which is a very popular average? Normally, the 50-day average is not structurally important, meaning you can cross over to cross 100. Who cares? Normally, that's the case. Same with 200-day. But in this case, gold happened to build structure at its 50-day. If you look at the price chart even, you see that first hit stopped at the 50-day. And then the rally that occurred in April after the March sell-off, what did it do? It bumped the 50-day, and it bumped it again. So when you plot the oscillator below, which simply measures each bar in relation to how much above point-wise below the zero line, below the 50-day, you'll see there's a ceiling at the zero line. Bump, bump, bump. This report's a couple weeks old. We crossed above that level, just above 4,000 a couple weeks ago, where we had another rally in price from a low. So who knows, maybe this rally is just yet another failing rally, right? You've already had 2 of them. This is the 3rd one. Is this one going to fail? The momentum chart says, no, you're doing something different this time as of 2 weeks ago. You've crossed over a major momentum structure that you don't see on the price chart. You don't see a flat floor and a flat ceiling or anything like that. In fact, to take out that April high that got up to 4,900 almost, you have to exceed 4,900. We've already exceeded it on momentum. So momentum says, no, I'm born again. Okay. So what we're arguing at MSA is that this protracted but intermediate trend decline, which is not a long-term trend, The long-term bull trend in gold and silver remains up. You've not broken anything on momentum there. The only thing you broke was this intermediate stuff. But this action 2 weeks ago says, nope, I'm reborn. This rally will be different. And sure enough, 2 weeks later than this report, it is different. We're much higher than where we were at the time of that breakout. Same is true with silver. So what we argue is the monetary metals have completed their intermediate overlapping corrective process in price. Momentum says it's green light again. We're going back up. And this time we're going to continue to go up. You could look at silver on the next page if you want. It's no big deal. It's essentially the same story. So game is on again. The problem with gold at that high and silver as well in January was that you had late market chasers, people who entered at the wrong time. Our buy signals for gold and silver, well, I'll talk about silver, for example. Over the last couple of years, we said in March of 2024, excuse me, we said buy it at $25, $26 zone. And in June of 25, we said buy it as it approached 35. In November of last year was our last buy signal at $56. That's an average price of $38 for those last three buy signals. Unfortunately, too many investors came in when it crossed 100 and said, oh boy, I believe it now. Well, they got bagged. The people who bought it at the right point suffered a pullback, but it didn't destroy their position. And now it's reasserting itself. Silver example here. This is silver weekly price chart, top. It also had three waves of decline. And if you look at momentum, there's also three hits. And the third wave didn't make a new low compared to the second wave down, whereas price did take out the prior low. Okay, now, when you look at the price chart, you have these two failing rallies. How do we know this isn't just another failing rally? Well, because for 13 weeks, I think it was, see that red line on the momentum chart, the horizontal. The momentum action was capped perfectly at the 3-week moving average. Bang, bang, bang. Now, price kept making lower lows during that time, but momentum kept making the flat ceiling. So if you looked at that bottom chart and treated it as a price chart, you'd say, oh boy, you crossed that red line, I'm going to turn bullish. But unfortunately, most people look at the price chart. Anyway, that broke out 2 weeks ago as well. Silver has since gone, it's up to 66 today. Anyway, so the metals have turned. This rally is for real. And the rationale for it is not the war, transient event that it will be. It's the ongoing historic degradation in the money unit, now being fully panicked and fully throttled by the central banks due to the threat to their bond market. That's the real fire in the house. It's not the Iran conflict. Yes, that causes news headlines and it causes tightness in oil, et cetera, which was going up anyway. It's due to the ongoing decay in that which we call money. And if all of a sudden the world recognizes at some point, due to a crisis likely global, that, hey, this fiat game has not worked for decades. We need to go back to gold-backed, monetary metal-backed currency, where we know it's valuable. It holds its value. Well, the Western world is not doing that, including Japan. They're just printing, which is fuel for gold and silver. That's the world we live in. Nothing you can do about it but be on the right side of it.
The global fixed income landscape is undergoing severe technical deterioration that standard central bank policies cannot stabilize. Long-term 30-year U.S. Treasury bond futures have collapsed toward multi-decade monthly price lows, driving benchmark sovereign yields to restrictive territory and breaking key technical baselines. Concurrently, the U.S. dollar index exhibits persistent secular weakness after failing to sustain higher valuations. Equity exposure within the financial sector remains exceptionally vulnerable as banking liquidity pressures and private debt strains mount. When sovereign paper across major economies, including Japan, Europe, and the United States, experiences broad institutional selling, monetary authorities respond with heavy currency debasement. This ongoing loss of purchasing power directly reinforces the structural floor beneath physical bullion, establishing gold and silver as essential stores of value. The loss of confidence in fiat instruments reflects a systemic crisis in sovereign debt management rather than short-term market fluctuations. Now, let's get back to the interview.
We have a debt crisis, and that's going to be front and center. We've been arguing that for quite a while. That back early this year, we defined the dollar index in March of 2025. It was 104. Right now it's trading around 98. We said it's headed into a major bear. It stalled for a while, but still in a major bear. Now it's starting to head down again. But the real issue is the bond market. And the bond market collapsed in price from 2020 to 2022, most of that occurring in 2022. From a price, I'm talking 30-year T-bond futures now, not the short end of the market that the Fed plays with, but the long-term end that they don't control very well. Price was over 190 in the futures. Yields were low and collapsed down to 117 and a half. Look at that drop, 190, 117 by 2022, most of it occurring in a couple quarters, okay? Since 2022, you could draw a line on T-bond futures on a price chart, or therefore on a yield chart the other way, sideways. And bonds have been doing this, trying to bottom, trying to peak the yields. But we started to slip about several months ago. We put out a warning that, okay, the T-bond attempt to hold is failing. Price then was like 114. We're now, trading down to 107 something the other day. Last month's close was the new low monthly price close for T-bonds going back a quarter of a century, meaning a new high in yields. And now they came in today with this thing. We got a little rally in the T-bonds because the Fed's going to try, et cetera, and the Treasury. This isn't going to help the problem. The problem is far too big. It's a crisis level problem. Japan went through it. Now we're entering that same hellhole. And once that happens, all faith in British bonds, EU bonds, et cetera, out the window. Because, hey, if Japan couldn't hold up, U.S. can't do it either. Oh, my God, we have a crisis. It's beyond the control of the central banks. And once that occurs, there will be wave effects in all kinds of markets, in particular financial related sector of the U.S. stock market, which we plot closely, because it is very, very vulnerable for a major decline to lead the way. Not AI and semiconductors, which have already started down, but you got to watch financials. That's really the heart and soul here. Because if you start to get even one headline out of the financial sector about, oh my gosh, I didn't know it's not a regional bank, or some debt crisis. We know there's a lot of private debt crisis as well right now. Then suddenly it's arms in the air, and the central bank has to go absolute ape. And the only thing they can do is print. The Fed responded to a collapsing situation in the case of 2007. They cut rates in September 2007. About 2 weeks later, the market in October 2007 went up and made a new high. Oh boy, they cut rates. It was a surprise rate cut, by the way. That was the top. They cut rates all the way down and the S&P collapsed anyway. And then they finally did a QE starting in November of 2008. That's like a year and a month off the high, which was October 2007. And did that stop it? No, it kept going down to March of 2009, substantially more. What did it do? Gold exploded right up out of a low. It had already been going up massively since 2001 and 2. But in 2008, it had a similar correction to the S&P for about a month. But then immediately V-bottomed and exploded out of there and continued on up, doubling its price over the next couple of years. Because the Fed came in and they took a page out of the Japanese book and they did a QE, Bernanke did. Right now it's bigger though, because you don't have just might have a bank go under. Countrywide credit's going in trouble. Now it's government. You can't have that happen. If the investment public, not just ours, but around the world, perceives major government bonds as questionable, that's like the table. You might as well pick the tablecloth off and everything shatters. Okay, that's where we are, because that is happening, and the fact that the Fed and the Treasury are having to respond the way they are, or what the BOJ has been doing to try to defend the yen and their bonds, print. That just simply destroys the money unit even faster. So when Besant made that statement today, what did that admit? Panic. That's what it admitted. And therefore, gold and silver said, oh, yeah, we knew that anyway. Now look what the miners did today. Gold's up like 3%, and the miners up 9%. Okay, we'll get on to that in a minute because that's a very important issue. But that's where we are. I think we have a crisis like we've never had that drives the gold move in an ongoing way, because this process, like you said, has been going on for decades, printing money, printing money. But now you have the bigger crisis that will cause them to print even more, to do things that we never thought of. Why? To keep the house from burning down.
The current macroeconomic environment presents structural hazards that eclipse the mortgage collapse of 2007. During that historical episode, aggressive interest rate cuts and quantitative easing failed to prevent equity declines, whereas monetary metals quickly completed brief pullbacks and doubled in value. Today, the underlying risk resides directly within sovereign debt instruments, which form the bedrock of modern asset pricing. Technical momentum oscillators highlight a distinct separation between nominal prices and underlying market strength. In silver, a 13-week horizontal ceiling on momentum oscillators was decisively breached, even while nominal price bars recorded lower lows. Similar dynamics unfolded across gold at its 50-day moving average, signaling that intermediate corrective selling has terminated. When institutional faith in government bonds dissolves across major global powers, conventional fiat mechanisms lose efficacy. The continuous monetization of government debt forces a structural reassessment of sound money backed by tangible commodities. Unlike paper assets vulnerable to systemic solvency shocks, monetary metals maintain true liquidity throughout prolonged periods of financial restructuring. Positioning in hard assets offers resilience against systemic balance sheet dilution. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.